Today, uncertainty rules. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, the Federal Reserve Chair Jerome Powell, in his second day of congressional testimony, told the Senate Banking Committee that the economy was in a sensitive phase. In this very sensitive time at the moment, it's important for us to be careful in the way we conduct policy simply because things are so uncertain and we don't want to add to that uncertainty, he told the Senate lawmakers on Thursday. Federal Reserve Chair Jerome Powell said the upward pressure on inflation was expected to continue for at least a while and flagged the risk that the Ukraine crisis would prolong supply chain problems, which have been a key driver of inflation. It's not going to help at all with supply chains because ships are not being offloaded, Powell told members of the Senate on Thursday. And he noted that the surge in energy prices would likely spill over into inflation, and if that shift proved to be lasting, it could put upward pressure at the margin to longer-term expectations. So markets continue to be unsettled as investors pore over developments between Russia and Ukraine and wrestle with the economic outlook against the backdrop of higher rates and stronger inflation. Volatility is going to continue to be around and to be an issue, said Mark Shokel, Chief Executive Officer of Adams Funds. We are positioned for oil to go higher. There's no question that this is going to be a headwind. Policymakers are facing an unenviable situation over the near-term. Inflationary pressures are mounting, while the broader outlook grows more uncertain by the day, wrote Deutsche Bank strategist Jim Reed. There was some progress on the Ukraine-Russian talks, meanwhile, as both sides reportedly agreed to organise safe corridors to evacuate civilians and to deliver humanitarian supplies. And French President Emmanuel Macron reportedly warned, however, that the worst is still to come in Ukraine as Putin is hell-bent on taking full control through either diplomatic or military measures. So the S&P 500 slipped on Thursday as investors piled into defensive sectors of the market amid those ongoing concerns that Russia's invasion of Ukraine will add to the red-hot pace of inflation that threatens to derail economies around the world. As a result, the S&P 500 fell 0.5%, the Dow Jones Industrial Average fell 0.3%, and the Nasdaq Composite fell 1.6%. Interestingly, utilities, a defensive corner of the market, was the biggest sector gainer as investors mulled the prospect of further inflation pressures following Russia's invasion of Ukraine, as prices for oil, wheat, and precious metals trended higher. The 5-year break-even rate on Treasury inflation-protected securities, that's a closely watched gauge of inflation expectations, jumped to 3.23%. That's a record high. And US oil prices briefly rose to $116 a barrel intraday, pushing gas prices above $5 a gallon in some parts of the US. And oil prices ended the day in the red in a dramatic turnaround after the German economic minister Robert Habeck said he wouldn't support a ban on imports of Russian oil, gas and coal. And as the OPEC Plus coalition tried to ignore an oil shock unleashed by one of its leading members, relations with consumers are deteriorating. The 23-nation group led by Saudi Arabia faced a yawning gap in supplies when it gathered on Wednesday as the market shunned supplies from member nation Russia. The International Energy Agency had already tried to calm the rally by deploying emergency stockpiles, but to little avail. Yet Riyadh and its partners offered nothing new to slow oil surge towards $120 a barrel, wrapping up their meeting in just 13 minutes. And on Thursday, the head of the IEA, which represents the US and other major economies, offered a terse and unusually critical response. In a word, it was disappointing, IEA Executive Director Fabio Borrell said in a call with reporters. I think we'll just leave it at that. Tech stocks struggled to add to their gains from a day earlier, with big tech mostly lower, while semiconductor heavyweights like Nvidia, advanced micro devices and Intel also weighed on the sector. Intel fell more than 1% after Morgan Stanley downgraded the stock to underweight from equal weight and cut the price target to $47 from $55, citing more actionable opportunities elsewhere. While the longer-term turnaround capability in Intel's core business is a positive, the next couple of years are likely to see the stock move sideways, and we see more actionable opportunities elsewhere in our coverage, Morgan Stanley said. The weakness on Wall Street comes just a day ahead of the monthly jobs report, which is expected to show the economy created around 600,000 jobs last month, although some traders are forecasting a lower result around 423,000 jobs. The monthly jobs report is going to be huge for the market ahead of the inflation data expected next week, which I think will be elevated, John Luke Tyner, portfolio manager at Aptus Capital Advisors, said. Our estimates is around 500,000 jobs, but I wouldn't be too surprised by a stronger print. There are still a number of people on the sidelines, but the reduction in stimulus and government subsidies, as well as the gap up in wages, could entice people to work, he added. And Federal Reserve Chair Jerome Powell also said the Ukraine war could have the effect of accelerating China's moves to develop alternatives to the current dollar-denominated international payments infrastructure. Powell said that China has for some time been working on the reserve currency status issues and has been developing a messaging system for international payments that's like the SWIFT system. The US and European nations have moved to bar Russia from using SWIFT, which is vital to international payments in dollars. That's been going on for some time, Powell said, of the Chinese efforts to insulate themselves. But Powell added, this may now change that trajectory. So standing back once again, you can see how all of the cross currents are running fast. The inflationary questions, the jobs question, the utilities and oil question, and of course the overall question of Ukraine. Time, I think, to be very cautious with regard to markets. I did say yesterday, on an up day, we get a down day. No surprise then that volatility remains elevated, risks remain elevated, and caution should be the watchword. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.